Hi, my name is Kevin Retcher, owner of First Meridian Mortgage. In today's video, I'm going to go over one of the most common questions I get these days. You'll have a client close on their new home. They'll sell their current home and they get this influx of cash that they'd like to get put onto their new home and want to know the best way to do that. They typically will ask, should I refinance? Should I make a principal curtailment? And about 50% of the people will ask about a recast. In many cases, a recast might end up being the best choice. Okay, so let's kind of get into those scenarios. So quite often, like I said, someone might buy that new home. They might put 10% down, go non-contingent on the sale of their other home, and they have mortgage insurance on the new home, and they have an influx of cash when they sell their old. So they may have a lump sum, couple $100,000 that they want to apply to the new loan. One of the key questions is how do I get it over there? What's the best way to do that? One of the main things that you have to understand is, are they paying mortgage insurance? And is the current interest rate environment in today's environment a higher rate or a lower rate than what they currently have? These are some key factors. The reason that they're key is, in fact, if you do a principal curtailment, that's not going to get you out of mortgage insurance, but then you could apply to potentially get out of the mortgage insurance through the investor and go through their process. If you refinance, that will get you out of the mortgage insurance right away. If you recast, a recast would facilitate the start of that process of having the equity, but you'd still have to apply to the lender to get the mortgage insurance removed. So let's get into what a recast actually is and what it does. A recast is also known as a reamortization of the loan. So you took out a 30-year mortgage, maybe you paid 6 months on it, you have 29 and a half years left at a 7% interest rate. And now you want to apply this extra $200,000 to the loan and lower your mortgage balance. What they will do is take that same 7% interest rate over the remaining 29 and a half years, and they will reamortize your new loan balance based upon that information. They'll allow you to recast typically once a year. The normal charge is roughly $350 to do that. What are the benefits? One of the key benefits is lowering your monthly mortgage payment on a cash flow basis. And if it was coming from the sale of that other house, you just got it moved over accordingly with a nominal fee, very cost efficient, $350. The nice thing about it is your interest rate, in fact, did not change in that process, okay? And the term did not change. So the loan didn't get any worse, and you only improved your cash flow position because you now owe less money. So a very efficient way of, in fact, doing that. It can be a strategic financial tool to helping affordability. Maybe you have other savings that you need to do, apply that additional money on a monthly basis to kids' college fund, things of that nature, paying off other debt, things of that nature. It also, when you recast and a lump sum, it avoids the hassle of refinancing and that paperwork. It's typically takes about the same amount of time for the lender to get it done as a refi, but definitely less paperwork. It maintains the current loan features, and you don't have to qualify to do that. So let's look at a scenario here. In this particular scenario, the person had the mortgage for 1 year. The loan amount was $495, and we essentially applied a $55,000 principal curtailment, and that mortgage payment here would have dropped $357 and provided them that flexibility and that affordability of an extra $357 per month. The other advantage that that large chunk of money did was it in fact saved them over the life of the loan, if they never refinanced, an additional $73,000 in interest by making that large payment up front. So it can be very advantageous both on a monthly cash flow and also long-term interest savings. So let's get into when a refinance might make more sense. So refinance itself, let's say in that situation, you did have mortgage insurance, and this large principal curtailment would facilitate you getting out of mortgage insurance. That's one key thing that a refinance would do right away for you. Another thing to think about is and to make sure that the interest rate that you're getting is the same and or lower than your current loan. If in fact you could get a lower interest rate in the process of refinancing, especially if you were able to refinance with no closing cost. I have been doing no cost refinance for 27 years for people. So in many cases, let's say you closed 6 months ago or a year ago at 7%, and now I'm offering 6.25% at no cost. You could save that difference and potentially get out of the mortgage insurance and lower your mortgage payment all at the same time, and the principal amount, which would lower the payment even more. So that could be a big factor. Also, maybe your credit has improved since you took out the loan. That could be a big factor also. Maybe the term could change to your benefit. Maybe you took out a 30, now you want to do a 20 on a lower payment balance, which might have a similar payment to the 30, but because you made that larger payment, you're able to pay it off on a 20-year basis instead of a 30-year basis. So that could be a key improvement also. And then in the process of getting out of mortgage insurance, one of those factors could be that you would, on a refinance, get to use the new appraised value. So let's say you purchased at $500,000, and now the house is appraising at $550,000, and you originally had put 10% down, and you want to put another 10% down. You might actually be able to refinance and not have to put that extra 10% down, or maybe the appraisal comes in 5% better, and then you only put in 5 instead of 10. So in many cases, with if you're buying in the spring market, sometimes by the fall, you already do have enough equity to potentially get out of that mortgage insurance in conjunction with just a normal refinance, whether or not you make that principal payment or curtailment anyway. A principal curtailment is when you make a large payment and you don't direct them to recast the loan. Principal curtailment would automatically switch up your interest and principal accordingly. So your payment would stay the same. So on a $3,000 payment, if your interest was normally $2,000 and your principal was $1,000, if you made a large $50,000 or whatever the case may be payment, your interest would decrease and your principal would increase, but your payment would still be at that $3,000 for the until the loan paid off. But the loan would end up paying off in a shorter period of time. So when you make a principal curtailment, remember that term is a function of what you pay to principal. I've made a lot of money in my career off of understanding that. I'm going to say it one more time. Term is a function of what you pay to principal. So if you make a large payment one time, $50,000 on your loan, and then never make another payment, that loan's still going to pay off much sooner because you paid that lump sum on the earlier years of the loan, which speeds up the amortization for the remainder part. So remember that one key point, term is a function of what you pay to principal. So in the end, we went over 3 distinct items here. Recasting a loan, which basically allows you to make a large principal curtailment very efficiently at a cheap cost, and allows you to lower that monthly payment and for household purposes of just having better cash flow accordingly. We went over refinancing, the benefits potentially there, getting out of mortgage insurance, potentially changing the term, potentially getting a lower interest rate. You do need to evaluate the cost versus the recast. We went over principal curtailments. Principal curtailments, remember, I've made a lot of money in my career off of understanding one thing. Term is a function of what you pay to principal. If you make a large payment in the earlier years of the loan, it shrinks the amount of loan because your payment still stays the same. It didn't get lowered. So every month you're paying more to principal every single month. You can also elect to pay an extra mortgage payment every year, either monthly or just a one-time, and that will shorten the life of your loan by 7 to 9 years, depending on how you do it and what you pay. So remember, term is a function of what you pay to principal. So it's okay to pay an extra $100, an extra $500 a month on a mortgage, especially if you can do it electronically. After 3 months, you'll think your payment's the higher amount and you won't even know the difference. So in this video, we went over those 3 topics. If you'd like to learn more about it, give me a call. My name is Kevin Retcher, 703-799-5626. To all the Marines out there, Semper Fi. Talk to you soon.